You did everything right. You went to school. You got a job. You opened the app, watched the numbers go up, felt something close to hope, and then kept waiting. That was 7 years ago. And here you are. Not broke, not rich, just suspended somewhere in the middle, wondering if the math was always supposed to work out differently for you, or if something much larger went quietly wrong while you weren't looking. The answer is both. And that's what this video is about. Let's start with a number. 37. That's the median age at which Americans today will cross $100,000 in net worth, not liquid cash, net worth, which includes the equity in a car that's depreciating and a retirement account you can't touch for 3 more decades. In 1989, that milestone happened around age 28. Same country, same currency, 9 years earlier. And before you say it, yes, inflation has been adjusted for. This isn't a math trick. This is a structural delay baked into the modern economy, and most people have no idea it exists, let alone why. So let's talk about why. The story people tell themselves goes something like this: work hard, save money, invest early, retire comfortably. It's a clean arc. It feels logical. And for about 30 years, roughly 1950 to 1980, it was actually true. Here's what was happening in that window. Wages were growing. Not just in dollar terms, in real purchasing power. A factory worker in 1965 could buy a house on one income. Not a starter home, a house. Health insurance came with the job. College was cheap enough to pay for with a summer job. The economic ladder had rungs. And each generation could see the one above them and reasonably expect to climb. Then something shifted. Not dramatically, not overnight. But slowly, almost imperceptibly, the rungs started getting farther apart. Between 1979 and 2020, worker productivity in the United States increased by roughly 61%. Wages, over that same period, grew by about 18%. Think about what that means. The economy got significantly more efficient. Companies produced more. Profits expanded. And the people doing the producing captured less than a third of that growth. Where did the rest go? Not as a conspiracy. Not because of one policy or one villain, but because of a cascade of decisions about tax structure, about trade, about corporate governance that individually seemed reasonable and collectively rewired the whole system. Capital started beating labor. Not sometimes. Structurally. If you owned assets, stocks, real estate, businesses, you got rich. If you sold your time, which is what most people do, you mostly kept pace with inflation. Sometimes not even that. Now here's where it gets personal. The standard financial advice of the last 2 decades assumed you were playing on a level board. Spend less than you earn. Max out your 401k. Invest in index funds. Time in the market beats timing the market. This advice is not wrong. But it was written for a world where housing cost 2.5 times your annual income, not 6 times. Where student loan debt averaged $12,000, not $37,000, where a single unexpected medical bill didn't cost more than a used car. The model assumed a certain baseline, and for a large and growing slice of the population, that baseline quietly disappeared before they even entered the workforce. So they followed the rules, and the rules kept working. Just slower, smaller, with more friction than the brochure described. Here's the hidden mechanism that nobody puts in the infographic. Wealth compounds. You know this. Compound interest, the 8th wonder of the world. Einstein allegedly said it. Every financial influencer has repeated it 17 times this week. But here's the part that's harder to say out loud. Compounding also requires a starting point. If your money compounds at 7% annually, $100,000 becomes $800,000 over 30 years. That's real. That math works. But if you spend your 20s paying off debt at 6 to 8% interest, which is what student loans cost before the rate hikes, you're not compounding wealth. You're compounding against yourself. You're running a race where someone else gets to start on the 5th lap. The gap doesn't just persist. It widens. Automatically. By design. Not maliciously, but mathematically. And this is why the median 35-year-old today has a net worth roughly 40% lower in real terms than a 35-year-old in 1989. The compounding didn't fail. It just started from a worse position, with more drag, later. Now let's talk about the hype, because the last decade produced an extraordinary amount of it. Crypto was going to democratize finance. Anyone could get rich. The little guy finally had a seat at the table. Meme stocks, NFTs, yield farming, the metaverse, and embedded in all of it was the same seductive promise that you had finally found the shortcut, the thing that would compress decades of patient investing into months, the thing that would let you skip the rungs entirely. Some people made real money, mostly people who got in early, got out before the collapse, and didn't go back. The majority of retail investors who entered crypto between late 2020 and 2022 lost money. A study from the Bank for International Settlements found that roughly 75% of crypto investors globally ended up in the red. Not because they were stupid, because the structure of the game rewarded early adopters and extracted from late ones. Which is, again, not a conspiracy, just math. The irony is rich and almost cruel. In an era when traditional wealth building felt broken, the alternatives that promised to fix it were even more extractive, just faster and louder. So where does that leave us? Here's the honest zoom out. The system is not broken in the sense that it's failing to do what it does. It's working exactly as structured. It's transferring wealth upward, concentrating assets, rewarding capital over labor, and doing so consistently, across decades, across administrations, across ideologies. The uncomfortable truth isn't that you did something wrong. The uncomfortable truth is that the game changed and the rulebook didn't. And the financial advice industry, the books, the podcasts, the YouTube channels, including in some ways this one, largely sells you optimization strategies for a system without ever questioning the system itself, because questioning the system doesn't get you to retirement. Optimization, at least, gives you something to do. There's a version of this story that ends with a call to action. Invest smarter. Learn more. Build multiple income streams. And look, those things are not useless. They're real. They matter at the margin. But there's another version of this story that ends with a different kind of question. If an entire generation followed the rules, worked harder than the generation before, produced more, innovated more, stayed more connected and more informed, and still arrived at middle age with less wealth, more debt, and dimmer prospects than their parents had at the same age, then at what point does the story stop being about individual financial decisions? At what point does it become about something bigger? I don't have a clean answer to that, and anyone who tells you they do is probably selling something. But I think the first step, the only honest first step, is to stop blaming yourself for a headwind you didn't create. The math was harder than they told you. It was always harder.